I'm Matt Bishard with REIT.com, and joining me for this episode of Fundamentally Speaking is Calvin Schnure, NAREIT's Vice President of Research and Industry Information. So Calvin, let's start by taking a quick look back. In the fourth quarter, commercial real estate performance was kind of mixed. What's your take?
That's right, Matt. We got a so-so report on the fourth quarter. There was some improvement, but it really wasn't very exciting. There are two parts to what's going on here. The macroeconomic factor is we really don't have a very strong economy yet. The overall recovery has been, middling. It's been weak. It hasn't generated a whole lot of jobs. Households are still struggling to pull out of what happened during the financial crisis. But that's offset because there's very little new construction, almost no new construction, especially in the retail sector. So whereas we saw little improvement in demand, there was even less new supply. There were even fewer deliveries. So we saw vacancy rates tick down across the board, across all property sectors.
And now let's focus on a sector-by-sector basis, starting with the retail. What are you seeing there?
Well, retail, there's a divergence within that sector as well. The community and neighborhood shopping centers and the second-tier malls really are not doing very well. They were, no strong gains. The one area where you are seeing reasonably good performance is in the Class A malls. The Class A malls have posted much better performance with the stores that they have, the customers that they have coming in. Overall, if you look at the sector as a whole, we saw a slight decrease in vacancy rates, but the vacancy rates are still quite high. But we've seen continued rent growth, which again, that reflects two parts of the picture. You're seeing stagnant rent at the second-tier malls and community shopping centers, but you're seeing moderately good rent growth at the Class A malls.
And how about office? We obviously see a lot in the news as it relates to the office sector. What's your take there?
Overall, job growth in the fourth quarter matched about what it had in the previous quarters. And indeed, for 2012 as a whole, we saw about the same number of jobs as we saw in 2011. About 150,000 jobs a month, which is really not enough to make much progress. So we're really marking time while we're getting through the various things that have been holding back the recovery. It's been a very prolonged, weak recovery, and we're still seeing that. And the commercial the office sector properties are reflecting that. But again, as we saw with retail, the very low level of construction, almost no major new deliveries in the quarter, means that we saw some improvement in vacancy rates. They edged down, and actually we saw an acceleration in rent growth in the quarter.
Now switching to apartment sector and picking up on that idea of supply, apartments one of the few sectors where we are starting to see some new construction. How is that impacting the sector?
Well, it is interesting that we saw a small decrease in vacancy rates in apartments, but for a very different reason. That's because there just aren't very many left. There's a 20 basis point decline in rental vacancy rates according to the REIS data, and that brings it down to 4.5%. Now, 4.5% vacancy rate is already quite low. But during the quarter, we saw demand that was about twice the level of the new deliveries. So we are still seeing a lot of people going out there and signing leases. So where does that leave us right now? We're not seeing a lot of improvement in multifamily, but it's continuing to move forward. But what's going to get interesting is when the job market improves more to see what happens with these people once they get a job and they go out to sign a lease.
And obviously the big news related to the economy is that the fiscal cliff was averted, at least for now. What impact now moving forward do you see that and the general state of the economy for 2013 and how that impacts commercial real estate?
Well, let me take that one piece at a time. First of all, the budget deal, as imperfect as it may be, averted a lot worse that would have happened if they hadn't passed it. The sequestration, that is just cutting off the spending cuts and the tax increases that would have taken effect if they hadn't come to some deal, again, imperfect as it is on many accounts, we avoided far worse damage to the economy. But even though we avoided that, the deal is going to be slowing economic growth. In particular, the increase in the payroll taxes is going to take a fair amount out of people's spending. That's another 2 percentage points, 2% out of most workers' paychecks. That's mostly going to have an impact in the first half of the year. I'd expect GDP growth to be, say a full percentage point slower in the first half of this year from what it would have been otherwise. But that's not the end of the world. we're in a situation where the economy actually did gain some strength at the end of last year. Remember, people have been worried that the economy might be losing steam heading into the holiday season, but it turns out the economy actually accelerated to just over 3% GDP growth. So if we continue that, we could still see GDP growth of 2% or on the shy side of 2% in the first half of the year, but then gaining strength and accelerating in the second half of the year, because the long-term fundamentals are the disappointing recovery is gradually gaining momentum as the drags, including this fiscal drag, start to fade.
Calvin, thank you so much for joining us.
It's been my pleasure, Matt.
For more on this and other REIT news and analysis, be sure to visit REIT.com.